Today we would we'll look at our next topic, which is the time value of money in finance. And in our last class, I encouraged everyone to read ahead so that we can be a bit fast, because we don't really have so much time and we still have a bit to cover. But if we read ahead, it will help for us to move faster. That way we can just touch on important key areas, and then we can then take questions to clarify areas that might not be too clear. So for today, we are going to be looking at the time value of money and how we apply the principles of time value of money in both fixed income and equity, the valuation of fixed income and equity instruments. Now, this topic is very critical and it's important because it's one of the building blocks of a lot of valuation you will draw throughout the CFA curriculum, even up to level 3. So it is important that you understand the structure, how it is put together, especially at the basic level. What is covered here in this topic is at the core, but it's very basic. But if you understand it at this level, as you go to level 2, where you actually do a lot of heavy lifting, you find it very useful. Because having that foundational knowledge will help you to apply to so many scenarios that you will see in the future. Now, just to understand the general relationship, which you might be familiar with because of the other courses or modules that you might have done, is the concept of present value and future value. And what does that mean? Present value is the current value. And so typically we typically use present value and price, but they are not necessarily the same thing. And the difference is this. The present value typically is the intrinsic value, what is really worth from a valuation point of view. Something that you can calculate, something that you can decide quantitatively in a way. And that is the present value or the intrinsic value. But the price can be anything. For example, if you go to the stock market, I can decide to buy a GT at a price. You come into the market and decide to buy GT at another price different from my own. Now, how do we decide which of the prices is actually the correct price or is the intrinsic price? The truth is that they are both prices. I could have factored in a lot of things that are not quantitative into mine. Maybe I want to hold it as a strategic holding. Maybe I want to buy GT, for example. Maybe that might be my reason for buying it. Therefore, that would flow into the price I'm paying. And therefore, that would not necessarily be the intrinsic value. The intrinsic value should naturally be what you can calculate based on available information, right? And so that would most times be different from the present value, the market or the price in the market. But the understanding here is that present value is that value of that instrument that you can quantitatively find out by using formulas and by using available information about that instrument. The future value is the value of that instrument in a time t in the future. And the thing really is, for every instrument, there is what we call the cash flow. The cash flow that accrues to you from that instrument. Now, take a bond, for example. If you buy a bond, if you buy a coupon bond, over the period of time, you will be entitled to what we call coupon that will be paid to you. Those are cash flows. And at the end of the period, you also be entitled to the maturity value, which is also a cash flow that will accrue to you. The summation of all of this is called the future. Now, because this cash flow will come in the future, they are not going to come today. They are called future cash flow. Now, a very important principle in finance is the principle of discounting. And that is how we can relate future value to present value. How do I know that $1,000 today is equivalent to $1,000 tomorrow? The truth is, it's not equivalent. And the reason for that is, if you give me $1,000 today and I put it under my pillow and I bring it out in 1 year's time, would that $1,000 still remain? Even though the paper, as in the money, will still remain the same, the amount on it will still be $1,000. But if I take it to the market and try to use it to buy goods, I may not be able to use it to buy something that I will be able to use it to buy now. Now, let's look at an example close hole. At the beginning of sometimes last year, let's say groundnut oil, maybe 3 liters of groundnut oil will be 4,500 or less, or maybe 3,500. That is 3 liters of, take one of the brand in vegetable oil, 3.5 liter. Let's say it's 3.5. But today, if you go to the market, that same liter is about 12,000 naira. What that means is, if I gave you 3,500 last year, and you decide to keep that 3,500 under your pillow, and then you come today, and you bring out the 3,500 and you take it to the market, will you still be able to buy that 3.5 liter of vegetable oil? The answer is no. So even though the paper you're holding has nothing has changed, but the purchasing power of that instrument, of that paper, has reduced significantly because you can no longer buy what you could buy. Therefore, you would then say that the value of 1,000 naira or $1 today is not the same as $1 tomorrow. How do we then equate it? We equate it using the discount rate. The discount rate is the equivalence factor that equates $1 today to $1 tomorrow. So if the discount rate, for example, is 5%, if you are giving me $100 today, it then means that if you're going to give me that $100 in a year time, you have to make it $105 for it to be the same as as $100 today. That way there is equivalence. That way I will be indifferent between if you give me $100 today or if you give me $105 tomorrow in a year's time. But if the discount rate is 5% and you're going to give me 107 next in a year's time, then there will be arbitrage. Clearly, because the discount rate suggests that the value should be 105, but you are going to give me 107. So I'm making an extra money that is riskless. I'm making an extra $2 that is riskless. Arbitrage has set in. What if you then decide to say you're going to pay me for 104? It means you're not paying me enough for the risk that I'm taking for waiting for 1 year. What that means is that by the time you give me 104 in a year time, I will not be able to use it to buy what $100 can buy today. Therefore, the discount rate is what equates your present value to your future value. And really that is the setup. And that is what you see in your equation 1, which is the most basic formula for time value of money. Future value is equal to present value 1 plus r raised to power t. Now the t depends on the length of time, the length of time that you have. And again, if you then compound into infinity, that is, if you compound, continuously, that formula changes to equation 2. That is, future value is present value and exponential r multiplied by t. That is if it is continuous compounding. Now, the formulas in this module, you would have to understand and remember a lot of formulas. As at the last count, I think there are about 10 formulas you would need to remember here. Starting from these two we have touched on. So it's important that as we go through this curriculum, you take those formulas and then you write them down and be able to recall those formulas. Because what they are going to test here is they will give you a set of questions. You determine which of the formula applies. You apply that formula and you get your answer. It is that straightforward. But if you know which formula to apply and you cannot remember the formula, then it becomes a problem. So here you must be able to remember the formulas. There are about 10 formulas here that you will be required to remember. So just prepare your mind as we go through it. And also, we can also convert equation 1 to equation 3 by stripping out the present value. So we know that future value is equal to present value 1 plus r raised to power t. What if what we are looking for is present value? So you can then express that in equation 3, where present value equals future value into bracket 1 plus r raised to power minus t. Now that's the formula for present value. Okay? Now, that is the basic of the time value of money. Now, this formula applies across, and you will see the variations as we move along. But first and foremost, let's start by looking at fixed income instruments. Now, when we talk about fixed income instruments, you talk about your bonds, you talk about your treasury bills, and you know quite a number of them in our own market. But there are typically three different types of general pattern of fixed income instruments that we have. We have the discount, we have the periodic, and then we have the level payment. The discount instruments are those instruments you buy at a discount. You buy it at an amount, and then at a future amount, it pays you what you call a face value. It does not pay anything in between, and therefore your return on that investment is the difference between the amount you pay today and the amount you get back in the future. Now, let's say, for example, that the present value is 800. That is what you pay today, and here we are assuming that the present value is equal to the price. And I've explained to you why sometimes it may not necessarily be, right? Now, the present value is 85, and then the maturity value is 100, right? The difference between 100 and 85 is the return that you've earned on that investment over the period, right? And that is for the discount instrument. And we'll drill down a bit about on that shortly. We also have the periodic interest. Periodic interest is that fixed income instrument that pays you interim cash flow, interim income over the period, which are the ones we are very familiar with. So we are familiar with your treasury bills, for example, and your commercial papers. They are like discount, they will fall into the discount bucket because you pay present value for them and they are mature at the future value, right? Now, but your bonds, your different type of bonds, your federal government bonds, state bonds, sukuk and all of that will fall into your periodic interest, not sukuk, because sukuk is really, we don't call the return on sukuk interest because that's not the right terminology. So look at your federal government or your state government or your corporate bonds. They are typically structured with periodic interest, so they fall into the second bucket. And what you find out is you pay an initial price, PV, and then you receive interest over a period of time, and then at the end of the period you get your maturity value, which is your face value plus your last interest. And then the last pattern is where you have level payment. Level payment is that you pay a certain amount now, and then you get a level payment over the period, over the tenure of that investment, and that's it, or up until maturity. The level payment you get in year one is the level payment you get in the last year. It doesn't really change. In the interest, in the periodic interest, you will get only coupon in the intermediate periods, but at maturity you get the bulk, which is your maturity value and your last coupon, right? But in the level payment, what you get in year one is what you get in year 5. It's all leveled up, right? So that is the three pattern. Now, this first exhibit just shows you the discount instrument in a graphical format, right? Just in a picture format, just to make it clearer. So, assuming you are the investor, when you pay that present value, money will leave your pocket. So that's why you can see that you go down first, the present value, because you pay an amount, it leaves your. Then you get nothing for the 5 years. That's why you can see that there's nothing on the line for the 5 years. And at maturity, right, you get a total, which is your future value. And that total consists of the present value you paid and then a portion that is your interest. So the difference between the present value you paid and the future value is the interest over the period. And that is the portion that is colored in red. And that is just a graphical representation or dramatical representation of this bond. And how is this calculated? How is this calculated? How do you calculate the present value of a discount bond? It's simply the future value over 1 plus r raised to power t. And this formula equation 5 is an important formula that you must remember. Now, how do you then know when to apply this formula? When you look at the question, look at how it is structured. So they will give you clues into what type of instrument we are talking about. For example, if in the setup of your question, you hear something like, or you see something like 0 coupon, that tells you that we are talking about a discounted bond or a discounted instrument. Or they tell you that at a discount price, or they tell you that there is no intermediate coupon or payment, within the period, that tells you that this is a discount bond, and therefore the formula to apply will be your equation 5. So look out for that. Now let's quickly look at an example here. In example 1, discount bond under positive and negative interest rates. Now, just to say that under discount bond, you can actually have both negative and positive interest rates. That could be a question that should come up in a statement to say, can you have a negative interest rate under a discount bond? The answer is yes, you can have both negative and positive. Now, so let's look at this example. Consider a principal cash flow payable in 20 years on a Republic of India government bond issued when the yield to maturity is 6.7%. For a purpose of simplified example, we use an annual compounding. So this is compounded annually, that is T, in equation 5 is equal to the number of years until the cash flow occurs. Now, what should an investor expect to pay for this discount bond per 100? Like this is Indian currency. So if it suits you, you can say $100 just to make it easier, but it's the same of principal. How would you calculate this? Now, you have been told in the question, pay for this discount bond. So pay close attention to how the question is structured. Here you have been told specifically it's a discount bond, which means that the structure we've talked about earlier applies. Now there are 3 structures, but what structure applies to this one is the first structure. So this is a discount bond, right? And so the next thing you want to remember is, so what is my formula setup? What is my formula setup? And then the third thing is, what are the inputs to that formula? Those are the 3 steps. 1, understand the structure so that you understand what pattern. Next is, what is the formula for this? And the third is, what are the inputs? How do I identify the inputs for that formula? You slot in those inputs into the formula, you calculate it, you get your answer, and you move on. And that's how it works. 3 steps to calculating this. So let's look at this first one. The formula that applies here is your equation 5. That's why I said it will be important for you to remember your formula, because the question asks PV is equal to SV over 1 plus R raised to power T. Remember, the question is, what should an investor expect to pay? That is the present value. This way, we're assuming that the price to pay is equal to the intrinsic value PV. So the formula that applies is your equation 5. And you will see that PV equals like 100, which is the face value, over 1 plus the yield to maturity raised to power 20, which is the term, which is your T. And the answer to that is 27.3. It's very straightforward. So when you remember the formula, you remember what you're dealing with, and then you slot it in, you'll get your answer. You can see very straightforward answer. Now let's look at example 2, variation to example 1. If we assume that interest rate remains unchanged, what is the price of the bond in 3 years' time? Now, the first question, we calculated it 20 years' time, right? That is the time, the tenor. But now we've moved 3 years in, and then we need to calculate the price again. What price should we be willing to pay right now? What's the intrinsic value if we have moved in 3 years into the tenor? The first adjustment you need to make is, if the total tenor is 20 and you've moved in 3 years into the total tenor, what is the remaining tenor? Which will be your 20 minus 3, which will then be 17. It means you have 17 years left. All you have to do going forward from this point is apply your formula, which, if you can remember very well, you are putting the figures into it, and then you calculate it. It hasn't changed. The face value is 100, which is the amount you get back at the end. 1 plus your yield to maturity hasn't changed. The question says that assume the interest rate remain unchanged, and you calculate it based on that. You can see that it is now raised to power 17. That is the remaining time to maturity, and that gives you 33.2 lacquer. Now, so that is a variation where some time has elapsed, and you have to calculate the price for the remaining tenor. Let's quickly look at example 3. Now, prices also change as interest changed. Suppose after purchase at T0, we observe an immediate drop in the price of the bond to 22 per 100 lacquer. What is the implied rate, interest rate on the discount bond? So this question is trying to set it up to say, look, price has changed. Now you have been given the price that has changed, which means you have been given PV, right? But now you have to calculate R, because the question then says, what is the implied interest rate? So if you remember your formula setup, it means PV has been given, right? You know that your FV will always be 100, but R is not given, and that is what you've been asked to calculate. If you remember the formula, you can simply set up your formula, input what you have, and that is what you see here. I'm trying to highlight that. That's what they've highlighted here. Let me see. Okay, so can see that I've highlighted it. The PV is your 22.68224. That has been given, equals your 100, which is the face value, over 1 plus R raised to power 20. Because it says that suppose that you observe an immediate drop. Immediate means that we are still in now. You observe an immediate drop. So no time has elapsed, so the 20 still remains. So watch out for your questions, the way it is set up. And then you would that will guide you into how to apply. And so when you set it up like this, you can simply rearrange this to find R. And if you rearrange it, you will end up with 7.7%. 7.7%. Now, here's the thing. I mentioned in our previous class that sometimes in level 1, and in most cases in level 1, what they want to test is your understanding of relationships. It's your understanding of relationships. So in some of those questions, you really do not have to calculate. So if you're given question 3 and you're given 3 sets of answers, how would you immediately know, for example, without calculating what answer is correct? It's by understanding the relationship between yield and price. It's an inverse relationship, which means if the price of the bond drops, then the yield must have gone up. There are no two ways about it. Now we know that the yield from the previous example was 6.67, right? It was 6.7%. Now we are being told that the price has dropped. Now the price has dropped to 22. That should tell you that the yield has gone up. So if you're given 3 options, one is 6.67, one is 5.8, and the other 7 point something. Intuitively, you should know that the answer will be the 7 point. Why? It cannot be 6.67 anymore because the price has changed. If the price has changed, then the yield to maturity can no longer be the same. Now, since the price dropped, then the yield to maturity cannot be lower. It has to be higher. That way, you don't even need to calculate before you select your answer of 7.7 without calculating, because you understand the relationship between price and interest and yield. And that is what you've seen in example 4. Now let's in example 3. Now let's quickly look at example 4. Example 4 considers that unique case of a negative interest. And the question says, now consider a bond issued at a negative interest rate. In July 2016, Germany became the first Eurozone country to issue a 10-year sovereign bond at a negative yield. Even though this might be, not very, it's not very common. It's not, in fact, it's not common in our own environment, our local market. A negative yield phenomena is quite common in other markets. The Eurozone, for example. And here's an example. This is not a theoretical example. It's actually happened. If you look back and you look at the Germany 2016 bond, it's actually happened. So there could be negative interest rate. So when you see a question that is talking about negative interest rate, does it change your initial setup in terms of your formula setup, in terms of your calculation? Really, it doesn't. And that is the point here in question 4. So the question says, if the German government's bond yield to maturity is minus 0.05% when it was issued, calculate the present value. Now you remember that the present value equals your face value over 1 plus r raised to power the number of period raised to power t. But in this case, your r is negative. Now, what you need to do is to set up your formula the way you have always set it up, which means you will have every 100 over 1 plus into bracket minus 0.05. You close the bracket, then raise to power the number of period, which is 10. But in maths, you know that negative multiplied by positive would be turned to negative. Therefore, to open that bracket, your formula will change to 1 minus 0.05, because positive multiplied by negative will give you negative. So that sign then will change to negative. And that is why you see how you can see the way it is highlighted, the way it is set up here. That's why there is the minus here. That's why there's a minus here. So they didn't do anything differently. They just applied the formula the way it has been. But because minus and positive will change to minus, that is why you see that the sign changed to minus. It does not necessarily mean that because it's negative, then the formula has changed. The formula didn't change. But when you multiply, when you open that bracket, it's going to change to minus, and that's why it's minus here. The second thing you must be very careful of, especially when you work on this particular module, and generally when you work in level 1, is be very, very conversant with your decimal points. Decimal point is very important. Decimal point. You must be able to convert percent seamlessly when you're doing your calculation. Remember that the interest rate here is 0.05. Now, if it was 0.5, it will be half of 1. So it's not even 1% yet. It's 0.05. So look at the way it is converted. 0.05% is 0.0005, right? Percent. Remember that if it is 1%, if it's 1%, is 0.001. If it is 10%, it is 0.1. Right? If it's 100%, that is when it is 1. So anything less than 100% is 0. If it's 90%, if it's 90, it is 0.9. If it's 70, it's 0.7. But if it's 10, it's 0.1. If it's 1%, it's 0.01. This is not even up to 10%. This is not even up to 1%. So it's 0.005. So be very familiar with how you convert, because if you don't get the conversion correctly, you can throw off your answer. And so that is in case of negative interest rates for a discount bond, example for a discount bond. Now, what this also means is that the bond, when you calculate the present value is 105, which is more than the face value. Now, when you encounter a scenario like this, it means that the bond was issued at a premium. Typically, and in our own environment, bonds are typically issued at a discount. But in this example, especially in a negative interest rate environment, the bond will be issued at a premium. How would you know that it's a premium? That is, the present value is higher than the future value. The present value is more than 100. Let me put it this way, because the future value is always 100, right? So once the present value is more than the future value, that is, PV is higher than FV at 0, then that bond is issued at a premium. So the question might come up to say, is the bond issued at a premium, discount, or par? Discount means it is less than 100. It is less than 100. Par means it is the same as 100. So if the present value is also 100, then that bond is issued at par. So in our example 4, this bond is issued at a premium because the PV is higher than the FV. Now let's look at example 5. 6 years later. Now we are still talking about the same German bond, but we've now moved in 6 years into the future. Remember that the total tenor is 10. Now, when German inflation reached highs not seen in decades, and investors increased their required nominal rate of return. Say we observe that the German bond in question 4 is now trading at a price of 95 per 100. It's now trading at a price of 95 per 100. What is the yield to maturity on this bond? Now, two things have happened here. One, the question has moved us sometimes into the future. And the second is that we are then being asked to calculate R. We are now looking for R, right? Has anything changed in terms of your formula setup? Nothing has changed. The first adjustment you need to make is we've moved into the future. So it means that your remaining tenure will no longer be 10 years. It will be 10 minus 6. 6, yes, because it says 6 years later. So you've moved in 6 years. So it means that your remaining tenure will now be 10 minus 6, which means your remaining tenure will be 4. The second thing is that rather than look for PV, you are looking for R. So when you set up your formula, you simply just convert it to solve for R instead. So that applying your formula as before, you get what I'm highlighting now. This is now your new formula setup, right? This is your new formula setup. Your PV has been given, that is 95.72, equals to your face value, which remains at 100, over 1 plus R. R is unknown, raised to power 4. 4 is remaining time to maturity. Then when you solve for R in this equation, you get 1.1%, which is the answer that you're looking for. So to summarize, in discount, you've seen the different scenarios that can come up. But once you remember how your formula is set up and how you adjust for when you have moved into the future, and how you adjust for depending on what you're solving for, either PV or R, then you're fine, irrespective of if it's a negative interest rate. So three variations can come up here. Number one, you can get a plain vanilla question here where you're given all the parameters and you are asked to calculate. That is applying your formula directly and you get it. The second variation is that you can be moved into a time in the future. How do you adjust for that? Simply deduct the total tenure minus the time that has elapsed. What is the third variation? The third variation is that you can be asked to look for R instead. And all you need to do is set up your formula and then make R the subject of formula, that is, bring out R and you calculate. It's still the same thing. And the fourth variation that can happen is if you are given a situation where you have a negative interest rate. So you can see, ensure that you have covered these 4 variations and you're fine on any question that relates to this. Okay? Yeah. And you're fine on any question that relates to this. Any question before we move to the second variation, which is coupon increment? Any question? Any question? All right, thank you. So let's move to the second variation, where we have the coupon instrument. We talked earlier about the coupon instrument, and we talked about how the way coupon instrument is set up. The way coupon instrument is set up is that there's typically a present value, then you have payments over a period of time, then in the final period you get your payment and the final value or the face value, as the case may be. Diagrammatically, this is how it is represented. So your present value is the amount you pay for the bond at inception, then over a period of time you get payments. Now you can see here in this example that there are, let me see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There are 10 payments. PMT, the payment, there are 10. And that's because typically for coupon bonds, the coupons are paid twice a year. And that even applies to our own Nigeria and our markets. Coupons are paid twice a year. It's paid half yearly, every 6 months. So that is why you see that there are 10 payments, even though the term or the tenure of that bond is 5 years. And at the end of the 5th year, you get your last coupon. So you can see that in the 5th year, you have a payment plus the FV. So you have an addition of the 2. So you have your payment and the face value, which typically the face value is 100 or 1,000, as the case may be. So understanding this structure, let's now look at how do you then calculate the present value? How do you then calculate the price and other parameters like we did in the first bond? The first thing you must understand is equation 6. The first thing to understand is in equation 6. In equation 6, you can see that each of the payment is discounted. appropriately. So you can see that payment 1 is discounted by 1 plus r raised to power 1. Payment 2 is discounted by 1 plus r raised to power 2, and like that. And the last payment is payment plus the future value discounted by 1 plus r raised to power n. That is the applicable discount rate for that year, for that period. And to understand this, let's look at an example. Okay. Now, if the observed yield to maturity at issuance was jumping. At the height of the COVID pandemic, the government of Greece issued a 2% annual coupon bond maturing in 7 years. Now you can begin to see how we have moved from the discount bond. Here we still have the number of the maturity period, but here we have what we call coupon. So take note of coupon. Now when you see a question like this, how do you know what to apply? The word coupon has been mentioned. It tells you it's a coupon bond. It's a coupon bond. And that is the difference between this and what we talked about earlier when they mentioned discounted. So how would you know what to apply? Look at the wordings and look at the information you've been given about the bond. It will help you to know if it's discount or if it's a coupon bond. So in this example, we've been told that there is a 2% annual coupon. The annual coupon is the payment. So in applying it to your formula, the 2% annual coupon, your coupon is the payment, is the periodic payment. And that the period is 7 years. So we've been told that it matures in 7 years. Now, you also observed that the yield to maturity at issuance, question 1 now, was 2%. The YTM is 2%. What was the issuance price? Here we are being asked to calculate the PV, euro 100% of formula. Now, two things here. One critical thing to think about here. If you get a question like this, if you understand the relationship ab initio, you will understand first and foremost that you do not need to do any calculation here, even though you can calculate and get your answer. Why? We talked about earlier in the previous example, how do you know if bond is at a premium, at par, or at discount? It's at a premium when the present value is above face value. It's at a discount when the present value is below face value. It's at par when the present value is equal to the face value. However, how do you know that a bond is at par? A bond will always be at par if the coupon rate is equal to the observed YTM, yield to maturity. So the coupon rate is 2% and your yield to maturity is also 2%, that bond is at par. Now, but if there is a difference between the yield to maturity and the coupon rate, the bond can either be at a premium or at a discount. In fact, if the yield to maturity is higher than the coupon, then that bond will be at a discount. If the yield to maturity is lower than the coupon, then it will be at a premium. And that's how you know. So if you let's go back to question 1, it says that the yield to maturity is 2% and the coupon is also 2%. No calculation required. This bond is priced at par. And par means that the present value is equal to the future value, so it's going to be 100. Now, just to show you how it works, the calculation, they still did the calculation. And this is where the calculation is important, because sometimes the yield to maturity and the coupon might not be the same. So you will still be required to do some calculation, right? How do you set up the calculation? You set up the calculation by discounting the present value. By discounting the present value of the coupon over the period. The present value over the period. And you can see there are 7 periods. And so the first period payment is 2. Now you will also note that they have simplified this question by saying that annual coupon. So always take note of that. Sometimes it could be semi-annual coupon. If it's semi-annual coupon, it means that the number of periods you have will be double the term. But in this case, it's annual coupon, so your payment will still be 7 because it's done annually. So don't forget that. Always take note of that, right? Now, so the setup here is you can see that each of the payments, and I'm highlighting that each of the payments is discounted appropriately. So the fourth year payment is discounted by 1 plus R, right? And your R is your yield to maturity, which is 2%, right? And you can see that, right? Now that first year is not raised to power anything, or you can say it's raised to power 1. So it's, which is still the same thing. That's why the raised to power 1 is not shown. Anything raised to power 1 is still that same thing. So 1 plus 1.02. How did we get 1.02? Is 1 plus R. So if you look at your formula setup, is 1 plus R. That's how you discount. And so the payments are all discounted, which is what I've highlighted. All the 7 payments for the 7 years are discounted. Now, after discounting that, you also need to then discount the final payment. The final payment. There's a final payment at the end of the period. There's a final payment at the end of the period, which is at the end of the period there is the payment, the last payment, and then the face value, which then gives you 102. You will get your face value of 100 and your last payment of 2, your last coupon payment of 2. So when you add that together, it gives you 102. Then you discount that at year 7 discount rate, and that is why you see 102, that is 102 raised to power 7. So for the last value, for the terminal value, you will have your 102, which is the value at year 7, over 1 plus R raised to power 7. And that is what has been done here. That is the present value of the final payment. That's the present value of the final payment, and this is it, right? The present value of the final payment. Just to make it easier, this has been tabulated. 0, year 0, that's when the investment was made. In year 1, you get your payment of 2. Your payment of 2, you discount that. The discount value of that is 1.96 at 2%, and you do that up to year 6. In year 7, you get your final payment and your face value, giving you a total of 102, and you discount that by year 7. When you add all of the PV together, you get the net present value, or you get your PV, which is what they have done, and that PV is the answer that you're looking for. Now, when you add all of that together, it's going to give you 100. It's going to give you 100. That's what you've done. That's what they've done. So if you add all of this, the present value in year 1 to 7 together, it's going to give you 100, which is the same as the face value. And as I mentioned earlier, you don't really need to solve this if you get this in your exam. If the yield to maturity is the same as your coupon, just know that it is priced at par, which means the price is 100. Now let's look at the second question. Let's look at the second question let's assume that exactly 1 year later, so we've moved 1 year into the future, there's a sharp rise in Eurozone inflation and drove the Greek bond price lower to 93.7. Here, 2 things have happened. You have been moved 1 year into the future, right? And then the price dropped, but you've been given the price, which means you've been given the PV, right? What would be the implied yield to maturity expected? What would be the implied yield to maturity expected under this new market condition? What that means is that you then need to find the present value of the remaining cash flow and really compare it to PV, right? You should, rather than compare it to PV, it should equal to your present value, because that is how it should be. But you don't know the R. So this question is saying, what is the implied yield? What is the implied yield to maturity? Or what is the implied rate of return, right, that investor has? What you need to do here is to set up your formula. You set up your formula by discounting each of the cash flow, which is what has been done here. But because you don't know R, you may need to iteratively find your R. Really, there's no formula per se for finding R in this situation. right? Or there is, yeah, I think there's no form. I don't know if you'll be given an Excel in the exam where you can just plug this into an Excel and it will still calculate it for you. But what you will need to do here is that you may need to do an iteration to find out the interest rate. But do not expect this level of complication in the exam. Why? If you're given an exam like a question like this in 2, look at your answers. Look at your answers and pick the middle one. Pick the middle rate. If you're given 5%, 7%, and 9%, pick 7%. Apply 7% in your formula and look at your answer. If your answer is greater than 93.09, it means that you need to go for the higher rate, which means 9 is the answer. If your answer is greater than 9.01, it means is it greater lower than 9.01, it means you have to go for the lower. So it means that the 5 is the answer. So all you need to do really when you get a question like this is to do one calculation. Pick the middle, apply it to your formula, get your answer. Depending if it's higher or lower than the PB you have been given, you can select your answer in the question in the exam situation. So don't let this throw you off balance. There's really nothing to it. Now let's look at example 3. Consider a 20-year Republic of India government bond, from which the discount bond was separated. So this is just going back to the earlier example, but now we're being told that this is a coupon bond. Again, pay close attention to what it is called, the coupon bond. The bond was issued at an annualized coupon rate of 6.7. Annualized coupon rate of 6.7%, and the yield to maturity of 6.7%. And the coupon payments are semi-annual. Solve for the price of the bond. Here you see another classic situation. Solve for the price of the bond. Before you begin to solve, ask yourself, what are the relationships here? Relationship 1, the coupon rate is 6.7, the yield to maturity is 2.7. You do not need to do any calculation. The price is 100. It's because it's at par. That is it. When you understand the relationship, you understand that you don't need to calculate this, right? The coupon rate is equal to the yield to maturity. Therefore, this bond has to be at par. And you can see that the solution says that it is 100 lakh at par. But of course, you can then want to do the calculation. Remember that this is a 40-year bond. So you have to do this calculation. This is a 20-year bond, but it's semi-annual, which means there will be 40 payments. And so if you want to do the 40 payments and discount each one 40 years and add it back together, well, that is your choice. But for a complicated question like this, especially because of the long period of time, they'll probably just set it up that in such a way that if you understand the relationship, you will know the answer. Because clearly, I do not think they expect you to calculate this in an exam situation. That is discounting each of these cash flow over 40 years. That's going to be a whole lot. It's going to take your time. And that is why it is set up like this. Just know the relationship and you're fine. Now, question 2. Question 2. What is the bond price if the yield to maturity immediately rises to 7.7%? What is the bond price if the yield to maturity immediately rises to 7.7%? Again, because this will require a lot of setup. We're talking about 40 years. It's really not very practical to say you want to start calculating. But again, if you understand the relationship, you should be able to get the answer. When the yield to maturity is equal to the coupon, it was at 100. Now the yield to maturity has increased more than the coupon. That is, the yield to maturity is now higher than the coupon. That tells you definitely that the bond price has come down. The bond price has come down. So when you look at the relationship between the yield to maturity and the coupon, you can tell where the bond price will be. Now, if you are given answers where all of your options are below 100, then that's where you can then say, okay, let me try and work with this. But if you're given answers where one is at 100, one is above 100, one is below 100, your natural answer is the one below 100. No calculation required. Why? If the yield to maturity is higher than the coupon, then the bond must be priced at a discount. That's what it means. So this bond must be priced at a discount, and that's why it's 89.88%. Okay. Now let's look at question 3. Let's look at question 3. Question 3. Recalculate the discount bond price for the final principal payment in 20 years. For example 1, using a 6.7% semi-annual discount rate. Now, what you're being told here is take the initial example that we have, but now calculate the final payment. The final payment is the final year payment, right? But assuming a semi-annual discount. In the initial example, we assumed an annual discount, but now we're saying assuming a semi-annual discount. What does that mean? The first implication of semi-annual discount is that your payment would not be equal to your coupon. Your payment will be your coupon divided by 2, because it's semi-annual. Only the last payment you will get will only be half of your coupon for that year, not your full coupon for that year. Because 6 months before then, you have been paid half, then the remaining portion will be paid to you at the final period. Okay? So what that means is that you will then have a situation where you have your final payment, right, plus your face value, your final payment plus your face value over 1 plus R. Your R would also be divided by 2. Your R will no longer be your total 6.7% anymore. It should then be half of that. And then you discount that at times 40. You discount that at times 40. And that's what you've seen set up here. And the answer to that is 27. That is the present value of the final payment. Present value of the final payment. Okay? And that's it. Okay. Any question before we move to the next pattern? Any question before we move to the next pattern? All right. Any question? Can we move to the next pattern? All right. Okay. So now the last pattern is the annuity instrument. You know, we talked about the discount, we talked about the coupon, and then we talked about the annuity instrument that pays a level cash flow over the period of time. It pays a level cash flow over the period of time. Here, and this is dramatically, this is how it is structured. You have the present value, that is the amount that investor puts in or the price paid. Then you have a level payment. If you check all of the bars, they are the same. They are the same from 1 to 360. They are all the same in height, which means the amount that is paid periodically is the same. But in that, the interest and the principal payment will be different. Now, the thing with the level payment is that every period you are paid, a component of that payment is interest, and a component of that is principal or an amortized principal, which means a portion of your principal is being paid back to you over a period. So when you get your last payment, which will still be a level payment, it's not going to be higher than other periods, and you would have been effectively liquidated at that last payment. And that's why it's called a level payment or an amortized payment, or depending on what name you want to call it. And so you can see that the bars are all the same, but the principal and interest component will change. Now, at the beginning stage, the interest component is actually larger. At the last stage, the principal component is larger. Now, if you work with banks, this is how banks' loans are structured. You will notice that the amount you pay for bank loans typically for most banks are the same over a period of time. But then the principal component of that amount would differ. At the initial stage, when you start paying back the loan, your principal component will be small. A bulk of all you're paying back will be interest. And that is why you see, if you look at period 1, the interest component is higher. When you look at period 5, the interest component has reduced, but it's still high. But when you look at period 360, the interest component is almost negligible, but the principal component has become a major part of the annual payment, right? And that is how this is structured. How do you then calculate present values? And how do you calculate, returns of this? Present value on this. Here, there is a formula you need to remember. I told you that a couple of formulas that you need to remember, and that is in equation 8. So you want to write it down, and you want to be able to remember it anytime, exam situation or any period. And that is A equal to R into bracket PV over 1 minus 1 plus R raised to power minus T. And that is your periodic annuity. Your period is called an annuity because it's a level payment. Remember that annuity is a level payment. And because what you're paying back every month or every period is a level payment, it's called an annuity. And this is the formula that you need to remember. This is the formula that you need to remember. This is the formula that you need to remember. A is the periodic cash flow. In this case, here you can be asked three things. You can be asked what is the periodic cash flow. You might be asked to calculate periodic cash flow. You might be asked to calculate the present value, or you might be asked to calculate interest rates per period, right? So these are three variations that can happen under this. So let's look at examples, and let's use examples to firm up our understanding of this. Number one, mortgage cash flows. The closest example of an instrument here is a mortgage, and that's why a mortgage is a go-to example here. An investor seeks a fixed rate 30-year mortgage loan to finance 80% of the purchase price, which is $1 million USD, for a residential building. Now, the first question says, calculate the investor monthly payment if the annual mortgage rate is 5.2. So you are being asked in this question to calculate your A. So if you remember your formula, then you are being asked here to calculate A. So like I mentioned earlier, once you have been able to identify what you are being asked, the next thing is the formula that applies. Remember the formula, you can write out the formula, then what you plug into the formula is the next thing. So here you're being asked to calculate A in this formula. So you have to solve for A. Now, before you solve for A, what is your present value? Your present value is the amount today. Now, what is the amount today? The question says that 80% of the purchase price is what you're financing, not 100%. So these are very technical things you just need to look out for and adjust. Now, 80% of 1 million USD is 800,000. So your present value is not the whole 1 million USD, it's the 80% of it, which is going to give us 800. And that is your present value. And apart from that, everything else is set up. You know that your time period is 30 years, and because it is monthly compounding, it means that it is 30 multiplied by 12, because you have 12 months in a year, monthly. So it will be 30 times 12, and that will give you 360. So your T equals to 360. And so you write out your formula and you plug into it. What you then have is 0.43. Again, you have to adjust your R. Your R must be divided by 12 because it's a monthly. So be careful to note the compounding period. In this case, it's a monthly compounding period. So your rate must be divided by 12, and then your PV is 800 as adjusted. And then you put in the rest of your formula, and then which is what has been given here, just here, and then you end up with your answer, which is going to be 4,417. That's your answer. So remembering the formula is very critical here. Now, what is the principal amortization and interest breakdown of the first two monthly cash flow? Of the first two monthly cash flow, what is the principal amortization and interest breakdown? Which is the second question you can get in this kind of scenario. That is the annual payment or the periodic payment of 4,417. How do you adjust it to get the interest element and get the principal element? The way to do that is calculate your interest element. That's the step one. Calculate your interest element. Your interest element is amount of the loan, which is 800, multiplied by the interest, which has been given, which is 0.43. Remember that you will divide your interest, your R, by 12, right? When you multiply that, you get 3,500. Now, your 3,500 is your interest for period 1, right? Now, because you know how much you already pay, periodic payment, 4,417, deduct that interest component from the 4,147. The remaining component is your principal component. And that is what has been done here. The interest component is 3,500, which is multiplying the amount of the loan by the interest, and the principal component is deducting your interest component from your annual payment, which gives 917 for period 1. For period 2, your principal a portion of your principal component has been paid to you, so it's no longer 800. So you have to take your principal payment in period 1 from the remaining from your initial principal component of 800. So it means that 800 minus the principal component of 917 will give you your principal component for period 2. And so for period 2, you do your calculation the same way. That is, the interest component will be your outstanding principal component multiplied by the interest component, interest rate, and that gives you the interest component, which is 3,497. Then you deduct that from the annual the periodic payment to give you the balance, which is your principal payment. And that is 921, and that is how to separate it into principal component and then the interest component. That's the second question. Two types of question that can arise from here. And you can see all of this in the tabulated format here. Any question before we then move on? So we've looked at the application of fixed income instrument under the 3 different cash flow patterns. Now we want to look at this on for equity. How do we use time value of money in an equity consideration, in an equity calculation? I'll take any question before we move on into the equity part. Any question? All right. So let's move on and then look at how we then apply time value of money to equity instruments. There are 3 general approaches when it comes to equity. 3 general approaches. Typically, the way you value an equity is that you value the cash flow of the equity. And most importantly, the portion of the equity that you value is the dividend, the dividend that is paid. That is what you really value, or that you discount to get what your intrinsic value or your present value is. But there are 3 key approaches depending on the type of assumption that can be made when it comes to an equity instrument. One is constant dividend growth. Now remember, what you discount is the cash flow, and for an equity the cash flow that comes from equity is your dividend that you pay. And then when you sell that equity at a particular point in time, the terminal value is also a cash flow. We know that for most equity instruments, it is never sold, doesn't mature. But if you have a time frame for selling it, you can also evaluate the present value of that terminal value that you get. But there are 3 approaches. The first approach is constant dividend. What do we mean by constant dividend? What do we mean by constant dividend? It means that the same amount of dividend is paid. The amount of dividend is constant. So if your dividend is 3 naira 50 kobo, it means it is constant. Come next year, it's going to be 3 naira 50 kobo. Right? Now, that is different from 3% dividend. If you say 3% dividend, it means that if your earning is 100 naira in year 1, your 3% dividend will be 3.5. If your earning is 200 naira in year 2, 3.5 of that is 6 point something or 7%, 7 naira. That is not constant dividend. So constant dividend means that the absolute amount of the dividend is the same. That's what constant dividend means. That is the first assumption that can be made. The second assumption is called constant dividend growth rate, which means the dividend grows at a constant rate. So the dividend grows at a constant rate. So if the dividend grows at 3% per annum, and that 3% per annum is constant, that is constant growth. So that is the second assumption and the second scenario. And the third scenario is changing dividend growth rate. which means it could start at 3%, it could then end up at 4%, or it could end up at 2%, which means the growth rate changes. The growth rate of dividends changes. Those are the three approaches in which we can value an equity instrument using time value of money, and then we'll take each one in turn. Now, this is the first approach, which is the constant dividend. You will notice that grammatically here, the dividends are the same, the bar are the same. That is, D1 is equal to D2 is equal to D3 is equal to D4 is equal to D5. Your present value is the amount you pay for the shares now, and your dividend is that constant amount. So this is a constant dividend payout scenario. And how do you do a constant dividend payout scenario? You get equation 9. And how do you do that? You simply do dt all over 1 plus r. That is, you discount your dt over 1 plus r. You discount your dividend. You discount each dividend. And then if it's into perpetuity, that formula simply becomes dt over r. The 1 plus r turns to r. If you discount it into perpetuity, there are formulation and all of that theories about how this formula changes from 9 to 10, but that is none of your concern. Just remember that, if it's constant growth into perpetuity, then what you have is dt over r. That is your constant dividend divided by your r, right? Your R is your rate of return on equity. This is also very important. You might be given different rate of return, but this is the rate of return on equity, shareholder rate of return. Because we're talking about an equity instrument here. Shareholder rate of return, simply stated. But again, it's very important to note here that the rate R that applies here is return on equity. It's the return on equity. So it's very important that you note that. It's not just any rate of return that is used in this calculation. It's your return on equity. That is the return that equity holders demand. You might see a question that gives you different rate of return. You might even be given a YTM. Please, this is not YTM. Because, it's easy to just see R and think you can apply it everywhere. This is not R. This is not YTM, sorry. This is the equity rate of return, or in another words, your return on equity. That's what you use in this formula. And that formula solves to equation 10. And this is the formula to remember for this kind of equation. If you want to write it down and recall it. Now let's look at an example. Shipline PSC is a company that pays regular dividend of 1.50. Regular dividend of 1.50, which means it's a constant dividend. It says a regular dividend, which means it's constant over time, of 1.50. And we have been told that it's expected to continue indefinitely, which means into perpetuity. What that tells you is that equation 10 applies. So, question 1. What is Shipline expected stock price if shareholders require rate of return? You can see here you've been given shareholders require rate of return. It's specifically stated. What will be the expected stock price? The expected stock price, of course, will be your DT, that is the dividend divided by the expected rate of return on shareholders, which is 0.15. And that is what is being done here to give you a present value of 10 pounds. And so that is the present value of the share. Alternatively, a common equity forecasting approach is to assume a constant dividend growth. It's to assume a constant dividend growth called G. Now, if you have a constant dividend growth G, what then happens is that in year 1, right, your dividend for last year would then become D1 plus G. That is, it will grow by the constant rate. It will grow by the constant rate. And so, if you continue to grow, it means that you can simply raise your G a raised to power the number of years that you expect it to grow to. So if you expect 5 years, it's simply 1 plus G raised to power 5. And so that is a constant growth. And when you look at constant growth, this is how it's set up diagrammatically. Notice that in under 1 is not D. 1 is D plus 1 because 1 is 1 period from now, which means the dividend 1 year from now will grow. It's not going to be the DO is typically stated as dividend last year. DO is stated as dividend last year. That is your DO. It cannot grow because you have been paid, gotten it. but your dividend next year is going to grow. So your D1 is always D1 plus G. If there is a growth, growth assumption factored into it. And so here is and so this is it. Your dividend grows at a rate of G per period, and you have equation 11. So your DT plus 1, which is your dividend next year, will be your DT, your dividend now, 1 plus G into the future. And typically, this generalizes for your I number of period, depending on the period, it generalizes. So dividend growth rate then generalizes to DT 1 plus G raised to power I, where your I is the period in future. And if it's into perpetuity, if it continues to grow into perpetuity, then that formula simplifies further. It simplifies further to equation 14. It simplifies further to equation 14, where present value is your DT plus 1, that is your dividend next year, over R minus G, assuming R is greater than G. The assumption here is your R must be greater than G. That is, your return on equity must be greater than your growth rate. Your return on equity must be greater than your dividend growth rate. And so, equation 14 is the formula you need to remember. Equation 14 is the formula you need to remember. But there's also a situation where you can have a two-stage growth. What we talked about earlier is one stage, is a constant growth, where G is the same over a period of time, over the entire investment period. But again, we can have a situation where we have two-stage growth. That is, it starts as a growth rate and then moves on to another rate. Typically, it starts at the high level and then moderate. And there is two reasons for that. When an organization starts, when a company starts, they typically enter into a stage called a high growth stage, where you expand very rapidly. And when you look at the technology companies, you will see they all went through the high growth rate, where the rate at which they expand was very fast. But as they move on, competition and a lot of factors come into the market, and they are not able to expand or grow at the rate at which they grew earlier. That way, the growth rate at this later stage will be lower than the growth rate that they started with. The growth rate at this lower stage will be lower than the growth rate at the started with. So that is the first thing to bear in mind. So your stage 2 growth rate is typically lower than your stage 1 growth rate. And the reason for that empirically is that companies tend to grow until they mature in the future. The second reason, which is very typical, is that your growth rate, the growth rate of equity, cannot exceed the growth rate of the economy. In fact, the growth rate of equity normalizes to the growth rate of GDP over time. And when you look at how in economics, when you look at how that is structured, the rate at which company can grow is really determined by the rate at which the economy in general can grow. So if the economy can only grow by 4%, then that is the maximum. Your long-term growth rate of the economy determines the growth rate of equity in the long run. Therefore, you expect that even if you start at a higher growth rate, it will moderate back to the long-term growth rate of the economy, of GDP, over time. So that is the second reason why you start with a higher growth rate in early years and then moderate in later years. So typically, for the sake of this example, you start with a higher growth rate and then you moderate to a lower growth rate. Okay? Now, and that is what is given here dramatically, where you can see that from D1 to D3, it's a growth rate, but from D3 henceforth, then you enter into a new growth level, and so which is GS and GL. So GS is your initial stage growth, and then from that point onward is a GL, which is a much more moderate growth, right? And so, and again, it's assumed that your GS will be greater than GL for the reasons I have stated. Now, which brings us to equation 15.
Yes. It's looking to the growth rates.
Yes.
in the long run.
In the long run. Long-term growth rate. So we're saying that.
I'm trying to look at the Nigerian scenario.
Okay, the Nigerian scenario. Yeah. Okay.
To me, that's is it flexible?
Oh. So
what has happened in the equity market last
yes, and that's a very valid and a very good question. Now, the way to think about it is, last year we did about 40% in equity. The question. So the question. Yeah, let me rephrase the question. The question was, is this observable in the Nigerian scenario? Looking at what the equity market has done and where the Nigerian growth rate is, GDP growth rate is really observable in the Nigerian market, right? Right. Now, the way to look at it is, so last year the Nigerian equity market did about 40%. Is this rate sustainable into the future? The question to that would be no. Even if it ends up, look at where we are right now this year. Even if it ends up during this year again at 70, does that make it sustainable? The question again will still be no. What that means is that over the long run, maybe in the next 10 years, you will actually see this growth rate moderate. And therefore, you might even see some years where you see a reversal, where you might see some years where you see negative return in the equity market. Because that is how it will work. It will normalize over time. But the second question is to also look at from a purely economic point of view will be, what is the economic capacity of Nigeria? We are growing at a below par rate. So we are growing at 3%, but really we are not maxing as a country. We are not working at what you will call at your full capacity. There is still a gap. There is still an output gap. We are operating below our output gap. Yes, gap. And therefore, what that means is, as long as you are doing that, you have a tendency for the market to outperform the market. But when Nigeria gets to a point where we are growing at that gap, at that rate, it will be difficult. It will be difficult, right? It will be difficult to see this kind of excess return in the market. And therefore, you will then notice that in the market, what will drive return would purely will be risk. And the way to look at that is, look at the developed markets. Look at rate of return even in equities in developed market. Do you see a situation where you suddenly just see 70%, 80% like you can see in developing market? The answer is no. And that is why you see the rate of growth in US. If they tell you that the rate of growth in US is 3%, 4%, that rate of growth is very close to the maximum. They are maxing the economy already at that 2-3%. Unlike Nigeria, where we have a lot of laxity, there's so much room. And the way you know there's so much room is, if you open a new business now in Nigeria, even if it's to sell phone, you still make money. Despite the fact that there's so many shops selling phones. If you cultivate an acre of land in Nigeria and plant food, you will still sell it off at a profit. Why? Because there is room for it. But in developed countries, any additional investment you want to make, for you to even be able to max the return on that investment, it will be difficult because the market is already saturated. It's already working at the limit where there's no extra capacity somehow. Therefore, you will see that the equity market in those economies are much more reflective of the overall growth, long-term growth of that economy. But for emerging markets, we are not there. And that's why you will continue to see this kind of excess return. And again, that is why a lot of foreign investors come in, why they like developing markets or emerging markets like Nigeria. They know that we still have the capacity. And therefore they can bring in their monies and invest, either FDIs or FDIs, because they know they will still make a whole lot of money from it. But if you take your money and invest it in the US or in UK, or for example, the rate at which you can make money on it is very limited. That's true. And so that's some of the reasons why we like our economy. And so let's look at equation 15. The equation 15 and 16, they are the equation that applies to this two-stage growth period. This two-stage growth period, where you have the growth period of one, the high growth period, and then you have the low growth period. And here's the formula, 15 and 16. For this formula, it is very critical that you remember this formula. There's no if you can't remember this formula, it looks somehow, but you can remember it. If you remember this formula, it's going to save you a lot. If you can't remember this formula, you have to work this out fully. And so I imagine that's going to be difficult. But the way to look at this formula is that there is a terminal period. There is a terminal period and a terminal value. The terminal value is when the high growth period ends, then you start the low growth period. So the low growth period, you kind of forecast it into infinity, and that becomes your terminal value, and then you discount that. That's how you arrive at terminal value. What's the terminal value of this stock? After it has grown for 3%, if it's then expected to grow for 2% going forward, you then look at the dividend at 2%, that is DT1 at 2%, and then you project that into the future to get a terminal value, and then you discount that terminal value at the appropriate rate. And that's what this just means. And so what is your terminal value? Your terminal value is given in equation 17. Now this whole equation 17 is the numerator of equation 16, the ESTN. So the whole equation 17 is that top portion. So this whole equation, right, is this equation is to find this terminal value here. Is to find this terminal value ESTN. All right. So what that means is that once you found this, it does not mean you should not discount it. You find it, then you still discount it. All right. Okay. So that is equation 17. Now let's apply this formula. Again, guys, I cannot overemphasize the need for you to remember formulas here. It's important. You remember the formula here, you get your point to move on. You know how to apply it, you remember your formula, you get your points and you move on. So let's go. Let's look at the constant and changing dividend growth. Let's look at the examples here. Now recall that based on a constant dividend, constant annual dividend and required rate of return of 15%, we show that cheap line expected stock price is £10, right? Suppose instead that an investment analyst assumed that cheap line will grow its annual dividend by 6% per year indefinitely. Now what does this mean? Cheap line will grow its dividend by 6% per annum indefinitely. What does that mean? What explanation or what meaning does it make to you in solving this question? What does it mean? Sorry?
Dividend changes every year. It grows every year.
It grows every year by what?
6%.
And that is a what?
Constant.
That's a constant growth. You see, it's a constant growth and it is paid indefinitely. It's a constant growth and it's paid indefinitely, which means there is no end period. So in that case, now before we go to the question, what formula applies here? And each person will give me the formula. Here you have to try to remember the formula. What formulas apply? What formula? Before we look at the answer, and we'll see if you get the answer. So what formula applies? Huh? What's the formula? Yes?
Formula 15.
Formula 15. So let's look at what formula 15 is, and then we'll see if we're correct. So your formula 15 is talking about the two-stage growth. So that won't be correct. I am assuming you are referring to equation 15, right? So this is equation 15.
Yeah, I mean equation 15, yeah.
And this is equation 15. Equation 15 is modified for two-stage growth. So this cannot be correct. This is modified for two-stage growth. But what we have seen is a constant growth, not a two-stage growth.
No, I didn't say 16 or 15, not 5.
Yeah, this is equation 15. I'm showing it on the board. Equation 15 is this. So you can see it's different. So perhaps you're referring to a different equation. Let's look at equation. Do you want to? Yeah. Yeah, equation. Yes, equation 12 or equation 12 or equation 14. I would think equation 14. Yeah, because it's into perpetuity, right? All right. So let's see what applies. So really, you see, it's important that you know the formula that applies and then how to apply it. Now you can see that the PV, as we're given here, is your dividend. Now your dividend, that is DT1. So it's important that you know what your DT1 is. DT1 is your dividend next year. So we are told that the current dividend or the constant dividend is 1.50. But that is not your dividend. That's not your DT1. So your DT1 will be, you grow your dividend by 1 year, and we've been told that the growth rate is what? The growth rate is annual dividend by 6%. So you grow that by 6%. If you grow that by 6%, you then get 1.59. So your dividend next year, DT1 becomes 1.59. All over R, and our R has been given as your return rate of equity, which we were given earlier in the initial example as 15% minus 6. 6 is your growth rate. And that gives us 17.67 British pounds. Okay, so what applies is equation 14. And you can see how you adjusted for your DT1, that is, you grow your dividend by 1 year, and that's what you use. And your return on equity minus your growth rate in the denominator. And that's it. So you can see very simple when you know what to apply. How does cheap line expect share price change? If we assume instead an initial growth of 6% over 3 years period, followed by constant 2% dividend growth thereafter. So here we're talking about the two-stage growth. So when you look at the question, you can easily identify a constant growth, which is the one we've just done, and a two-stage growth. The two-stage growth will tell you it grew by X amount and later by a Y amount, which is this two-stage growth. The key to a two-stage growth is on remembering the formula. Remembering the formula. Now, in remembering the formula, there's also one more thing you need to do. One more thing you need to do. The first part of the formula discounts the first growth stage, which is your DO, 1 plus your growth rates raised to power I, all over 1 plus your ROE raised to power I. Okay? But for your second stage, what you need is your DT3. That is, you need to find out your dividend at DT3. That is at the last stage of the growth rate, of the initial growth rate, and then you project that into the future to get your growth rate into the future, which is called your growth rate next year rather, and then you discount that. And so in this case, your initial growth rate GS will be 6, your later growth rate will be 2. All of the other formula will remain the same, but you then still need to find your DT plus 3, which is your dividend in year 3, which is your dividend in year 3. And so the first step is, solve the first step as, the first step is your dividend in year 3, cash flow for the initial growth period, okay? So solve for the initial cash flow in the first period. So the cash flow is your dividend and then the discount rate and discounted. And so your dividend year 1 will be 1.59. You discount that, it gives you 1.3. Your dividend in 2, 1.6, you discount that, and the summation of that is 3.82. That is your dividend for the initial period. Plus, you then want to get your dividend for the later period. Now, your dividend for year 3 is 1.73, 1.787. So that is what you need in your second formula. So you take that and then you grow it by 1 year. So you can see. So step 2. So step 2, they use the 3-step stage here. So the step 2 is really to find the terminal value, which is your D4. Your D4 is your dividend next year, all over R minus G. Okay? Now, your D4 will be your dividend in year 3 multiplied by 1.2, which is your D3 1 plus G. And that gives you 1.87, 1.894. Then all of that divided by 0.15, that is R minus G. Then once you get that, you can then discount that. What you will get will be your, okay, the answer is not given here, but once you get that final value, you discount it by the R1 plus R raised to power 3. Then the answer will be your 9.2. That is for the terminal value. And then the last step will be to add your present value of the initial cash flow with the present value of the second stage. So the present value of the first stage plus the present value of the second stage, that is 3.8 plus 9.2 to give you your final answer. And that is 13.05. Any question here before we move on? Any question here before we move on? We want to look at a bit of variation that can be applied to this. And two variations that, is your implied return and the growth rate. The implied return and the growth rate. How do you calculate your implied return and the growth rate? So before now, we're calculating what's the present value and all of that. But what if the question is calculate the implied return, or what is the growth rate? So for example, what is the R in our calculation in equity, or what is the G? So you could be asked to calculate any of that, right? The first thing to note here is once you know how the formula is set up, calculating any of R or G is simple. If you know how the formula for the equity is set up, all you need to do is set it up, plug in the value, and then use subject of formula to calculate what is being asked of you, either R or G. So the starting point for calculating the implied growth rate and return is understanding the formula setup. All right. So let's look at for fixed income. So let's look at fixed income. The first case in your fixed income is when you buy at a PV and it's discounted and you get FV back. Your return is simply the difference between your FV and your PV. Simple, discounted. That's your return. Okay. But then, what if you want to calculate what's your annual rate of return? Okay. The way to look at it is to use the formula. And there's a formula given grammatically. This is it. But this is the formula. And this formula applies not just to this, it applies to so many areas as well. Right? Where your R, implied rate, is your future value over your present value raised to the T root of that minus 1. Or another way to express it is raised to power 1 over T, then minus 1. Your minus 1 is what you do last. So if the field root is what is easier for you to remember, fine. If it's 1 over T that is easier for you to remember, that's also fine. So equation 18 is your formula for calculating implied periodic rate of return, implied periodic rate. So even though if you do PV minus FV minus PV to give you the return for the total period, but the question can be what is the annual period or the periodic period. That's what this calculates. So let's look at an example. Let's try and remember this formula, and then let's look at an example. Recall from example 1 that in 2016 the German 10-year bond investor pays a price of 150 and an annual yield to maturity of 0.5% attachment. That is, the German 10-year bond was initially priced by the market to provide a negative return to investors. 6 years later, these bonds traded at PV 95.72 to euro 100. What was the initial investor implied return on this bond over the 6 months period, over the 6 years period? What is the implied return? What is the implied return? So the question is straightforward. What is the implied return? You can simply just plug in your formula, which is R equals your FV. Your FV is the final value, which is 100, over PV, which is 95.72. The cube root of that, we've been told it's 6 years, so it's 6 cube root, or you simply just see future value, 100 over present value, that is 95.72 raised to power 1 over 6, and then you say minus 1 at the end of that. And that is what they have done here. You can see the way they have applied the formula. 95.7 over 100. 95.7 over 100 over 1 plus, over 1 plus, over 1 plus 6. Right? And so that is, and that's, when you apply it that way, just plug it into the formula you calculate it, it gives you a return of minus 0.81%. Straightforward. Apply the formula and you get your answer. There's no complication here. You see, the thing with time value of money is that there are so many parts to it. But once you understand it at the basic level, you can apply it anywhere and it's simple. Just don't deviate from your formula. Understand that this is the formula to use. Even if you're not clear about the answer, just plug in the input you have into your formula and work it out. You will always be able to get your answer. Okay. Question 2. What is the expected return of an investor who purchased the discount bond at 95 and holds it for the remaining 4 years? So we're saying that it's the remaining 4 years. Again, your formula applies. Face value is 100. Present value is 95.72. 1 over 4 the time to maturity. And then so you calculate that and it's 1.10%. 1.10%. That's it. You've calculated it. And so you can summarize the relationship. And by summarizing the relationship, you see that at the initial stage, first 6 years, the annualized return was minus 0.8. And if the annualized return was 0.8, then must earn 1.10 for it to give a total return of minus 0.5 for the entire period. And that is it. So you can see that from year 6 down, it earned 1.10. From year 0 to 6, it earned minus 0.8. But the annualized, the total yield to maturity will be over the entire period, will be 0.05. Yeah, that's what it means. What to note out here is, look at the question. Just know which formula applies and apply it, and you're fine. You can answer all the questions that you're going to give. All right, what we're talking about a coupon bond. Again, we've seen a coupon bond here. This is the setup of a coupon bond, which we talked about later. And in a coupon bond, you remember that you typically use the yield to maturity to discount it up to the future, up to the present value. Now, the other point is your yield to maturity is also your IRR. Your yield to maturity is your IRR, which equates your future cash flow to your present value. Your yield to maturity is your IRR, which equates your future cash flow to your present value, and that's how that works. And again, here is how it is set up. Again, this is here is you solve this through the iterative process. There is no formula per se to calculate this. You have to use the iterative process to calculate it. So let's see. Let's look at an example. Recall from example 2 that the 7-year Greek government bond, issued in 2020 with 2% annual coupon at the price of 93 per euro, principal 2 years later. So 2 years later, it now has the price of 3.091. What is the implied yield? What is the implied 2-year return for an investor able to reinvest periodic interest at the original YTM of 2%? What is the 2-year return for an investor that is able to reinvest the periodic return, the periodic interest at the original rate of 2%. So using equation 18, equation 18 means you have to discount each of the cash flow. That's what equation 18 is. You get that as 97.13, which means 2 multiplied by 1.2 plus 2 plus 93.091, which is the value you get at the end of the period. Then R is 97.13 over 100, all raised to power R. That is 1 over 2. 2 is the 10. So remember that T is 2. Then you do minus 1. At the end of everything, you do minus 1, and that gives you a minus 1.445%. This negative analysis was due to a 6.9 euro capital loss, which exceeded the periodic interest plus reinvestment proceed of 4.0. So reinvestment proceed, if you get 2% and you reinvest it for 1 year, plus 2% you get at the final period, the two cash flow will be 4.04. However, the capital loss was 6.91. Therefore, the return is negative. That's why it is minus 1.445. Now, let's look at equity instruments, implied return, and implied growth. I won't dwell so much here because there are two formulas you just need to remember. Now, the thing here is the formula for constant growth is what has been modified to find R and to find G. So the formula for R, modifying that, is R is equal to DT1 plus G all over PV plus G. So it just been modified. So what you need to remember is DT plus 1 over PV plus G. That is your formula for finding R. And the formula for finding G is R minus. So if it's G, you add, if it's R you're looking for, you add G at the end. If it's G you are looking for, you bring R to the beginning and you deduct every other thing from it. So it's R minus DT1 over PV. And to apply that formula, Coca-Cola company stock trade at a share price of 63. Share price of 63 means PV, and its annualized expected dividend per share during the next year is 1.7. If an analyst expects Coca-Cola dividend per share to increase at a constant 4% per year indefinitely, calculate the required return expected by the investor. So here you have been given the PV, you've been given the dividend, and then you are then asked to calculate R. So you simply just plug in your formula. Remember that the dividend per share during the next year, so you've already been given DT1, and that is why you can see that the slot starts directly into the formula. 1.76 over 63 over PV plus G. G is the constant growth rate. And so what if what you're looking for is the R, is GG, sorry, you simply just flip the formula and you calculate your G, which is plus DT1 over PV, and that gives you 0.0427. Now, before we move on, let's just quickly look at how we apply price to earning ratio. And so, any question here before we move on? Any question before we move to P? Let us take questions before we move on to the PE ratio. And essentially, we just want to see how we apply the PE ratio to value, and actually also how the PE ratio relates to the dividend cash flow, discounting cash flow, valuation method. If there are no questions, then we can move on. PE ratio is a relative valuation. What it means is price to earning, that is how much you pay per each earning. So if you earn $100, for each $1 you earn, how much are you paying for each $1 you earn? If your PE ratio is 20, it means that you are paying 20 times the $100 of earning, 20 times in price. If your PE ratio is 10, then it means you are paying 10 times And if your PE ratio is less than 1, it means the price is not even, you're not paying up to what one earning is. So typically you want to look for a lower PE, because a lower PE means you're paying lower for each dollar of earning. So if I can pay $5 for a dollar of earning, why should I pay 20 for each dollar of earning? So a 5 P ratio is better than a 20 P ratio, but not all cases. And let me aggravate a bit from here. What determines the price that investor put in is the growth expectation. So if they expect growth to be high or increase significantly, they can tend to pay higher price for the earning, because they expect the earning to grow rapidly. So what they are saying is that they expect that this earning is not the ideal earning. And if you check very well, that's what has happened to a lot of the technology companies, especially in the US. Their PE ratio are always significantly. Some of them might even be making losses, but you see their PE very high. And the reason for that is investors expect that this company will go or are in a phase where they can rapidly grow. And we've actually seen that in reality with some of the in the technology companies. So the way to do this really is to convert equation 14. Equation 14, you will recall, is PV D1 plus G all over R minus G, which is your formula for your constant growth, right? That's the formula for constant growth. What if we find the PV of this? What you will convert it to PV by dividing both sides by E. So if you divide both sides by E, the left-hand side of the equation derived to you will become PE. So your PV over E, this is your PE ratio, right? Is equal to this. So we are simply dividing both sides by E. So if you divide both sides by E, this becomes your PE ratio. So what we are saying is that your PE ratio is equal to something now. Now, what is D over E? D over E is the portion of your dividend, your portion of your earning that you pay out as dividend. That is your payout ratio. Do you get that? D over E is payout ratio. So we are saying that your price earning ratio is your payout ratio multiplied by 1 plus G over R minus G. So this is just in the means to simplify it, and you will see how that is applied. So remember that in an exam situation, you may just simply be given what is called a dividend payout ratio. So this formula enables you to know where to plug that in, right? The dividend payout ratio. So your D over E is your dividend payout ratio, right? Okay. Now we can then do what we call a forward PE ratio. The forward PE ratio is your PE ratio next period, the forward-looking PE ratio. And what would that be? It will be your PBT over your earning next year, your forward earning. So your E will become your ET plus 1, right? Then your DE will become your DE plus 1 over your earning plus 1. Your dividend next year over your earning next year. That eliminates 1 plus G. So you don't need to, because we've grown your DT and your earning into next year, because we are looking at a forward-looking PE. Therefore, the 1 plus G disappears. And that's why you see that formula then simplifies to equation 24, where you have your forward price to earning ratio equals to your forward payout ratio, if you can call it that, over your R minus G. Do you get it? So let's now apply this in a question. Suppose Coca-Cola trades at a forward price to earning ratio of 28. So we've been told that this is a forward price earning ratio of 28, which means in this our formula, PBT over ET plus 1 is 28, right? Equals its expected dividend payout ratio is 70, and analysts believe that its dividend will grow at a constant rate of 4% per year. Calculate Coca-Cola's required return. So with this, you've been given 3 pieces of information. You've been given 1, the forward price earning ratio, which is this. The PV over 80 equals, you've been given the forward payout ratio, 70, which is the DT1 over E, right? Then R minus G, we've been given the growth, which is 0.4%, but we're not given R. So this is asking us to calculate R based on this formula. So you can use this formula to calculate R, and you can see the setup. This is the setup. All you need to do is to slot the input into the formula. The 28 is the PBT because the forward, we've been told that is the forward P ratio. And 70% we've been told is the forward expected dividend payout or forward dividend payout. And then the growth rate is 4% we've been given. So what you then need to do is to calculate R. So you have your setup, and all you need to do is then make R the subject of formula here and calculate it. Simple and straightforward. And that's what they've done. Again, second question says, calculate Coca-Cola's implied growth rate. Assuming we're not giving Coca-Cola's implied growth rate like in question 1, but then they ask you to calculate it. How are you going to calculate it? Right? Again, you should slot in all of the things into the formula. 28 equals 70 over 0.65 minus G. And then make G the subject of formula and calculate it. That's what they did in 2. Nothing different. So once you know your formula setup, all you need to do is to put that, those inputs and calculate, and you're fine. So that's what you've done in example 2. In example 3, a stock index is trading at a forward price earning ratio of 90. If the expected dividend payout ratio on the index is 60%, an equity investor expects an index rate of return of 8%. Calculate the implied constant growth rate. Again, we've been asked to calculate growth rate. Your formula setup is the same. Your 19% is the forward PE. Your 0.60 is your expected payout over your expected return of 0.8% minus G. G is what you're looking for. So you make G the subject of formula and you calculate it. Any question? Let's look at question 4. Question 4 introduces a bit of twist that might be asked in an exam. So let's look at it. Suppose Coca-Cola stock trades at a forward price to earning ratio of 28, right? Assuming at price, and its expected dividend payout is 70. Analysts believe that Coca-Cola stock should earn a return, a 9% return, and that its dividend will grow by 4.5. Here you've been given all of the pieces of information. Recommend the course of action for an investor interested in taking a position in Coca-Cola stock. So here you've been given all of the pieces. So the first thing you do is calculate the intrinsic value here. What is the intrinsic value here? So based on all of this formula, what value should you get? What value should you get? So you can see that 70, the payout ratio over expected rate of return minus growth rate equals 15.5. But we've been told that the forward price earning ratio is 28. 28 is greater than 15. What should you do? What should you do? We're saying that it trades at a higher PE than what it's worth. It's trading at a higher PE than what it's worth. Now, if it's trading at a higher PE than what it's worth, what should you do? What course of action? Now, the course of action that is expected here is, at least at the basic level, should you buy? Should you take position in Coca-Cola? And when they say take position in Coca-Cola, they allow you to take opposite position, which means you can short sell. You can take any position. You can take a long position or a short position. That open, and that's what the questions try to address. Now that you know that the value, the forward PE should be 15.6, but it's trading at 28, what should you do to calculate? What should you do to calculate? What that means is that the forward price of Coca-Cola is going to fall. And if you expect the price to fall, what you then do is to take a short position. What is a short position? A short position is a situation where you borrow now, sell, and then buy back when the price has come down. So you take a short position when you expect price to come down, right? Because of the mismatch. With this mismatch, the natural thing to expect is that the price of Coca-Cola will come down. And so if I expect that the price of Coca-Cola should come down, what I will do is I will borrow Coca-Cola shares now, sell it at this high level, right? And then wait for the price to come down and buy it back and give it back to the owner. So if the Coca-Cola is selling at 15 naira now, I will buy it, I'll borrow it, sell it at 15 naira, right? And then when it drops to 30 naira, I will buy it back and give it back because I borrowed units. I'll give back the units that I borrowed to the person the person I borrowed it from. So it's to take a short position. And here's how to look at the mismatch and make a decision based on the match. Based on the mismatch. And I think the last part of this is to look at what we call the cash flow additivity. Cash flow additivity. Now, when we're looking at cash flow additivity, there are two basic points or two basic areas that it really covers. Number one is to understand that any cash flow index to the same period can be added. Any cash flow index to the same period can be added. And that is why when you look at coupon bond, the payment and the future value that is received at the same period is indexed to the same period, and so they are added. So, for example, if you expect a coupon payment of 2 naira and your face value of 100 naira, you simply add the two together to make 102, and you can discount both with one discount rate. But that's a relevant discount rate. You don't need to do it separately. That's what cash flow additivity means. As long as they are indexed to the same period, you can simply add them and do your calculation. Right? The second is that because there is cash flow additivity, well, for fixed income instruments, there has to be a match, irrespective of if you are doing a short term or if you are doing a long term. The cash flow additivity ensures that there is no arbitrage. And it ensures that it throws out arbitrage whenever one exists. And investors in the market can then take advantage of those arbitrage and then trade off the arbitrage. Because when you identify an arbitrage and you trade it, what will happen is that the arbitrage will disappear. All right? So let's look at basic cash flow additivity. Imagine two investments with two cash flows. Two investments with two cash flows. In the first one, you get 45 pounds in year 1, 45 pounds year 2, 45 pounds in 3, and you invested 100 pounds. Strategy 2, you invested 100 pounds, you get 60 pounds in year 1, 40 pounds in year 2, and 32 pounds in year 3. And the question is, which of these investments should you go for? Which one is better? The first thing you want to know is that you want to be sure that both of these investments has positive value. And the second is you want to know which one is higher than the other one. Right? But again, the simple way to actually evaluate this is find the difference between the cash flow, discount those differences, and find out if it's equal to 0. If it's equal to 0, it means that there is no difference between the two cash flow, meaning there's no difference between the strategy. And that's one way to demonstrate cash flow additivity. That is, you can take cash flow from a different investment and look at another cash flow from a totally different investment, but because they are indexed in the same period, you can sum them up, you can deduct them, and you can use the result to make a decision that will still be correct. So in this case, strategy 1, 45, 45, 45, strategy 2, 60, 40, 32, 35. How do you know which one to go for? So the way they went about it here, and to demonstrate cash flow additivity, is to deduct, to find the net. So 60 minus 45, 40 minus 45, and all of that. And what that gives us is For the first year, it gives you 15% GPP. That's the net cash flow. For the second year, -5, and for the third, -12. If you discount each of these, so it means you will discount 15 cash flow at 10%, -5 at 10% is per 2, and -12 at 10 per 3. The present value of this cash flow is 0. And because present value is 0, it means that strategy 1 and strategy 2 are equal. You see, you did not need to calculate on strategy 1. You don't need to calculate for strategy 2. You calculated on the difference between strategy 1 and strategy 2, and you are still able to arrive at your answer. This demonstrates cash flow activity, right? Again, the point here is if they are indexed to the same period, you can add them, you can subtract them, you can do anything with them. All right. Now, the other thing is implied forward rates using cash flow additivity. Implied forward rates using cash flow activity. How do we then apply cash flow to implied forward rates? Now, what do we mean by implied forward rates? What is the forward rate that is implied in the market at any particular point in time? Implied means you may not observe it, it may not be visible, but what is implied on the market? And the way to demonstrate that is, imagine that you want to make an investment. You have £100 to invest. You have two options. You can invest in a 2-year bond that pays you a 3% yield to maturity of 3%, 3.5 rather. Or you invest in 1-year yield at 2.5. And then when that matures, you invest the proceeds for another 1 period. Right? Are these the same? Can we have these two investments the same? What will make them the same is the forward rate. If the forward rate, there's a forward rate implied by this 1-year and 2-year rate. If the forward rate implied by this is not what is priced into this bond, then there's going to be arbitrage. That's what it's saying. So how do we then deduce the forward rate? Now let's look at strategy 1. Strategy 1 means that you invest today for 2 years at the known analyzed yield of 3.5. And when you find that, the value, the future value will be 107.12. That is the future value if you invest at 3.5 for 2 years directly. What if you go with strategy 2? Strategy 2, you invest at 2.5 and reinvest 1 year in 1 year time at the forward rate, the 1-year forward rate starting in 1 year. All right. And so these are the two strategies grammatically. Strategy 1, you invest £100 and then up onto 2 years. That's strategy 2. You get 107.2. In this other one, you invest 100. At the end of year 1, you have 102, but you invest that 102 at the forward rate to get X, right? So dramatically, this is just what you have. And so you calculate your returns. Now, the way to calculate returns here is to look at what implied forward rate will make these two, because really these two strategies shouldn't give a different answer. There shouldn't be a difference between you investing for 5 years and you investing 1 year and roll it over for 5 years. There shouldn't be. If there is, then it means that there's an arbitrage opportunity in one of the strategies. So you see people then go off one market and go and position in another market, or go off one market and go and position in another market. So it shouldn't make a difference. Another way to look at it is, if I buy a 10-year bond or I buy a 2-year bond, there shouldn't be any difference, right? My forward rate should compensate me over a period of time to make that two investment the same. If not, then arbitrage will come in, which means you will then see people probably sell down the 10-year bond and buy the 2-year bond, or sell down the 3-year bond and buy the 10-year bond to take advantage of arbitrage opportunity. Now, the way to find out the forward rate that equates, that ensures that there is no arbitrage, is what we have here. is this. Now just highlight this. Is this. F1 is 1 plus R2. R2 is your 2-year rate or long-term rate, raised to power the number of period, all over 1 plus your short-term rate, or everything minus 1. That is the formula for your F1. That is the formula for your forward rate. The forward rate is forward rate, 1 year forward rate 1 year from now. 1 year from now means, if I'm saying 1 year from now, I'm saying 30th of March next year, then 1 year rate from that point onward. Okay? So, what is done here is just to do the arbitrage, just to demonstrate how it generates a riskless profit. Now, if that is not the case, then you will generate arbitrage. If that is not the case, you will generate arbitrage. Now, let's look at example 13. Let's look at example 13. Forward rate changes. As out of June 2022 meeting, the Federal Reserve surprised market by raising its target interest rate by greater than expected 7.75 basis points. So the market expected, and this is very key for you guys. I mean, a lot of the things you would do professionally when practicing is that you try to understand what has been priced into every instrument. And so when in the last MTC that we had, right, markets, a lot of investors expected a 2% bips priced in, and you saw that the central bank did 2% bit. What if central bank has done 4% instead? What if central bank has done 0.5%? That is going to have implication on the asset prices. But if, as long as what the central bank did is in line with investors expected, then sometimes there might not even be any change in the asset price because it's already factored in. 2% hike is already factored into the instrument. Do you get it? So let's go on. So you can see that, so this exhibit presents 31st of May, just before the announcement, and then later after the announcement. Now we are seeing that on the 31st of May, the price of US Treasury stream 98 for 1 year and then 95 for 2 years. And then at the 15th of June, you can see that has dropped to 97 and then 93 respectively. Now, you see the information in Exhibit 11 show the change in the break-even year investment in 1 year's time. F1. So, what's the break-even forward rate? First, we use equation 15 to solve for each market discount rate. So, you solve for each market discount rate, right? Because you've been given the amount, you've been given the value, the PV. So, on face value over the current PV, all over the number of years, 1 over 2. And that gives you a discount rate of 3.17. Now, you can then, and so you can see, they solve for each of the points, and they've repopulated it in the second table. So you can see that R1 is 0.12 in May, that has now risen to 2.66 in June, and all of that. Now, what this means first and foremost is that because of the subprice, the market had to reprice that instrument. And the repricing is what you see here, when you see that it moved from 2.012 to 2.667. And then for the R2, it moves from 2.5 to 3.11. That is to factor in, to factor in the unexpected hike that happened. Now, how do we then calculate the forward rate, the implied forward rate? In May, the implied forward rate will be using the formula 1 plus R2. 1 plus R2, R2 is already given, raised to power 2, over 1 plus R1 minus 1. And then for 15, it has gone up to 3.689, which is 1.3177 plus over 1.267 minus 1. All right. Now let's look at the last, I believe that's the last, this is the last, forward exchange rates. Forward exchange rates using no arbitrage. This is also a demonstration of the value additivity, hash additivity, and time value of money. Now here, the setup here is very important. So it's important to follow the steps and the thinking around here. What we're saying is, in what we observe in the market today, there is an implied forward exchange rate. And if the forward exchange rate differs from what is implied, then arbitrage opportunity can set in. And what do we mean? Let's look at the example that has been presented. And please, it will be important for us to follow this step by step and understand each step that is explained. Because you will need this breakdown to be able to answer this question, the type of question in an exam. Assume that you have 1,000 USD for 6 months. So you have 1,000 USD that you want to invest for 6 months. And you're considering a riskless investment in either US or in Japan for 6 months. So you are considering a riskless investment. A riskless investment in USD will be Treasury. A riskless investment in Japan will be the Japanese Treasury, right? For example, a riskless investment in Nigeria will be maybe your 6-month Treasury bill in this case. Are we following? Now, so you have those two options. Let's assume that the current exchange rate between yen and USD is 1334. That is 1334 Japanese yen to $1. The 6-month Japanese yen risk-free rate is assumed to be 0.05. 6-month Japanese yen is 0.05. And the 6 months US dollar risk-free rate is 2%. This assumes a continuous compounding. So this assumes a continuous compounding. So what's strategy one? Strategy one is invest your $1,000 US Treasury. Which means if you invest your $1,000 US Treasury at 2%, you will end up having $10.50, around 5 cents. And how do you calculate this? Because it's continuous compounding, it's simply PV E exponential 2 over T, which is 1,000 exponential 2% times 5 over T, yeah. Over 5%, sorry. Risk-free rates, yeah. 6 months. 0.5 is half of a year, so that's why it's 0.5. So when you calculate that, you get 0.105 in USD. The second option is for you to convert the 1,000 USD into yen at the current exchange rate. Then invest that current exchange rate. Now, the forward exchange rate set today is 133.096. So let's see if it makes sense to go with this second strategy. So the first thing you will need to do will be to convert your 1,000 into yen, and that will convert into 134,000 yen. 134,000 yen. At 0.05 Japanese yen, so you invest that yen at 0.05, and that will give you 0.134433, which means 0.05 multiplied by half, right? And this exponential. The exchange so you would then have to exchange the Japanese loan proceeds for USD at the forward exchange rate. So when you convert this proceed 13443 at the spot at the forward exchange, or yeah, at the forward exchange rate at 133.06, you find that you end up back at 1010.05, which is the same as if you had invested in dollars. So here there is no difference. This investor is indifferent between investing in dollars or investing in yen based on the forward rate. But what if this forward rate is not 1330.96? It then throws out a lot of things. What if it is not? These two strategies are economically equivalent in that both involves investing 1,000 USD at T0 and receiving 1,010 in 6 months. And the element that links those two is the 133.096. And this is a dramatical representation of how this works. This is a dramatical representation of how this works. And really essentially it's just to take your 1,000, invest it, in 6 months you get your return, or take your 1,000, buy in, invest it, and then exchange back at the spot rate. So assuming that central bank respond differently to the sharp rise in inflation in 2022. For example, the Fed raised interest rate by 75 basis points, and in June, the Bank of England opted for a more gradual approach, raising its benchmark interest rate by 25 basis points. Now, the Exhibit 13 then showed what would happen, before and prior. Now, before the rate was 0.012 in USD, 1.29 in GP, and then one after the change has been made both in US and in GP, the price, the yield comes to 2.66 and 1.56. Now let's look at question 1. If we assume that the USD GP spot price of 122, right, from 31st December remain constant, how does the change in risk-free US dollar versus British pound rates affect the 1 year forward price? So how does this change affect the 1 year forward price? That's the question. This change in monetary policy, one person increased by 65, one person increased by 25, how does it impact exchange rate? So the first thing will be the no arbitrage forward rate increased to 1.26 to 1.274. So assuming that an investor had 1,000 GP to invest in 1 year in British pound or US risk-free, the US dollar need to purchase GP in 1 year must have the spot price equal to the discounted future price. That is, what you will get in GP, the spot price should be equal to what you will get from this other foreign investment. When you convert it at the spot price, it should give you what you end up with if you invest in a local investment. Okay? So as of 31st May, domestic strategy, invest 1,000.
That's fine.
But if you have the material, you can just follow. I'm on page 76. Now let's look at the domestic strategy as of 31st of May. So you invest 1,000 pounds at 1.27%, 1 year British pound risk-free rate, and you receive 1012.99. What's your foreign strategy? Foreign strategy is to convert your 1,000 pounds to GP, to USD, at USD 1.26 to receive $1,260.2 dollars, which you then invest in the dollar risk-free at 2.012 and generate a return of 1285.81, right, in 1 year. The no arbitrage USGP forward rate as of 31st March is therefore equal to, so you put the two values together, that is 1.285 over 1.012, and whatever that comes to is the no arbitrage forward rate. In this case, it's 1.269. Now, when interest rate moves, what is your domestic strategy as at 15th of June? So you invest $1,000 at 1.562% 1 year, and you receive 1015. Foreign investment convert to dollars, and you invest, and you end up with 1.294. And so the no arbitrage will be to 1.294 over 1.015, and that equals 1.2742. Now the last one we'll look at is what we call your option pricing using cash flow additivity. So I'll take any question here before we look at the final part, which is option pricing option pricing using cash flow additivity. Option pricing using cash flow additivity. This is going to be a very summarized version. Why? You will still deal a lot of option pricing in level 2 and others. So the examples here is really not the very tough one. Just understand the basics and you will find. Now remember that in an option, you can have a call option or a put option, which is also option to buy, the right but not the obligation to buy, the right but not the obligation to sell. Now that's what your option is, right? And your option is based on an underlying. So there's always an underlying asset. So if you buy an option on stock, that stock is the underlying asset. If you buy an option on bond, the bond is the underlying asset. So the value of the option is tied to the value of the underlying asset. The price of the underlying asset. So that is how it works. So let's look at an investor wishes to sell a contract on the asset in which the buyer of the contract has the right but not the obligation to buy the asset. So this is a seller of a call. That's the first thing to understand. This is a seller. An investor wishes to sell a contract. Now, what's that contract? The contract gives the buyer of the contract the right but not the obligation to buy. So the contract that gives you the right but not the obligation to buy is called the call option. Okay, so see how it's structured. So this is a call option, but from the seller point of view, it's selling a call option. Now, but not the obligation to buy the notes asset for 50. What is buy the asset for 50? That is the strike price. If you're familiar with option, then 50 is the strike price. At the end of the next time period, we can apply the principle of cash flow additivity to establish a no arbitrage pricing for this contract. A no arbitrage pricing for this contract. The binomial tree in Exhibit 14 summarizes the two possible future outcomes for this asset. Two possible features. Feature 1, the assets increases by 40%. So if the asset increases by 40%, then it will be 6. It should be 56 rather. And the contract will be 1/6. Because the contract owner will buy the asset at 50 and will be able to sell it in the market for 56. So the contract buyer will be able to make $6 or 6 yen. What if price decreases? The contract will be worthless because the call owner will not exercise the right. Rather, he would rather go to the market. So if the price has fallen to 32, the contract owner will simply go to the market and buy it. So rather than buy from you at 40 or 50. And that's what has been done here diagrammatically. The price can either go up. If you go up by 40%, you end up at 56. If it comes down, you end up at 32. But what is the payoff? What's the payoff on this? And this is the payoff. If the price goes up, it's 6. If the price goes down, it's 0. So that's the payoff, either up or down. Okay? So consider the position of the contract seller as follows. At 0, the contract is valued at C0, at 0. At 1, the contract is valued at either 6 or 0. Now, the initial contract value CO is unknown and may be determined using cash flow additivity and no arbitrage pricing. Now, this is a technical part that you need to pay close attention to. But don't worry yourself, it's not really, you will have the opportunity to do a lot of serious and tough options later. So this is the guidance for you. Okay, so let's continue. Now, the initial contract value CO is unknown and may be determined using cash flow additivity. So what we want to determine is your CO. We don't know the contract value. Now, that is the value of the contract and the underlying assets in each future scenario may be used to construct a risk-free portfolio or a portfolio where the value is the same both in this scenario. So you can construct an asset where either the price goes up or down, you end up at the same place. That's what this is. That's what this is. And really, that's what you want to do. You want a riskless portfolio. Because the moment you don't eliminate the risk, or the moment there is a profit to be made, you will arbitrage the setting. So you want to do a no arbitrage setting here. Okay. So for example, assume T is equal to 0 and investor creates a portfolio in which the contract is sold at a price TO. The contract is sold at a price TO and 0.525 units of the underlying assets are purchased. The 0.5% of the units of the underlying assets are purchased. The portfolio is called a replicating portfolio in that it is designed specifically to create a matching future cash streams to that of a risky asset, denoting the value of the value of the portfolio value at T, at TO, and T1 under condition under both prices increase and decrease. We have the following. I'll just continue. Now we've seen a three denotation here. The VO is, now recall that we had said that the investor sold at a price of, so the contract is price of CO, and then bought 25 units of assets, of the underlying assets. So what that means is bought 25 of each asset. The asset is currently being sold at 40, so 0.25 of 40 minus what that's the money paid out, and then the money came in. The money that came in is your CO. In option you call that a premium, right? That's your CO, right? That's at the beginning of the contract. At V1, which is what happened if at T is equal to 1, what is the value of the option if there is an upside? That is, there is a 40% upside and the price moved from 40 to 56. Then in that case, the payoff will be 6, which means you will have lost 6 and your total payoff will be 8, which means 25%. You will have gained 25% of 56, but you will have lost 6, which is the payoff of that option. And that gives you 8. What if it goes down? You will have lost 25% of 32, but you wouldn't lose anything more, which is 8. So you can see that the value at V1 is the same. Either it goes up or down. It's both the same at 8. Right? Exactly. So you can see that by replicating the portfolio is equal to seeing regardless of whether the price of the asset increases or decreases. And so because of this, the portfolio is risk-free and can be discounted at a risk-free rate as a risk-free asset. And the payoff for these two scenarios are then shown in Exhibit 16. So the payoff of these two scenarios are then now shown in Exhibit 16, which is, as you can see, in Exhibit 16, right? So essentially what we're saying is that, remember that at VO, we're saying that we bought 0.25% of the value of the asset minus S minus CO. That is what we bought from the option. CO is unknown, by the way. And so because we can then say this is the value of this asset regardless of what happened, that is V1 is 8 and V2 is 8, regardless of what happened, we can then discount that by 1 plus R. And so what we have is then 0.25 multiplied by 40, which is the value of that asset minus CO, is equal to the discount of 8 at the appropriate discount price. Is equal to that is the same because since it's riskless, those two things must be the same. What the value is today must be the same as if we discount what we get in the future, it has to be the same. Do you get? That's how it has to be. That's why you see that then the equated VO to the discount of 105. Then we can then solve for CO as 2.38, which means you simply can then solve for this. You can then simply just solve this equation, and it gives 2.38 as the fair price for the seller of the contract. So 2.38 is the fair price or the fair premium to set for this contract. Okay, and you can see that time value additivity, cash flow value additivity is how we're going to derive this. To say the value today must be equal to the value if we discount a known future cash flow at a particular rate today. It must be equal. And because we know it must be equal, we can use it to find the price of an option. And that's the application. Okay. Now, as part of the example above, we assume that the investor buys 0.25 units as part of the portfolio. Now, this proportion of the underlying asset is known as the hedge ratio. The hedge ratio. Now, let's look again at how this is set up. Let's use the Nigerian stock. Let's say I want to sell an option on GT stock, right? Now, our GT stock is selling at 40 here right now. I will set up a hedge ratio in which I will buy 0.25 of GT. That's my hedge ratio. So if GT goes up to 60, because I have 0.25 of GT, I will participate in the upside. But my participation will be limited to my hedge ratio, which is 0.25. What if GT goes down? I will lose. But my loss will be limited to my hedge ratio because I own 0.25 of GT. That's what the hedge ratio is. Now, in fact, the example just completed is a simplified process for solving for the value of a call option. This material will be covered in more details. As in our prior example, we compare the different strategies using cash flow activity to help solve for a low arbitrage price for a financial instrument. So let's look at example 15. And example 15 is a put option. A put option. Remember that what we did earlier was a call option. Now we want to look at a put option. And then we'll also apply the same set of steps to try to calculate the value of this put option. A put option grants the owner the right, but not the obligation to sell. Now, so different option and call option, we will cover that much more later. Call option gives the right to buy. Put option gives the right to sell. So if I have a put option on GT, it means I have the right to sell GT to you at the excess price. But I don't have to. So if the price of GT falls to 30 and my excess price is 50, I will sell it to you at 50. Do you get? Rather than sell it to the market at 30 and lose 20 naira, I would rather sell it to you because I have the right to sell to you at 50. But what if the price of GT goes to 80 naira? I won't sell to you at all because I can simply sell to the market. I have the right, but I don't have the obligation to sell. Do you get? I will simply sell at 80 naira in the market and make the money. That way, I will allow the option to lapse. But if the price of GT falls to 30, I will exercise my option. So that's what the put option is. The put option gives you the right to sell, but not the obligation. Now, if we assume that X, the exercise price is 50, then the put option value at one period P1 is equal to the max of 0 or Xn minus 50. Max of. So which one is max? For example, if the price of GT moves from 50 to 32, then the value at P1 will be 0 or 18, which will be 18. So the value will be 18. Do you get it? Now, that's what if the price of GT moves to 80? Then it will be 50 minus 80. That will be minus 30. 0 is greater than minus 30. So the mass will be 0. So this is for put option. That's the first thing. Now, using the 1 period binomial model with the same prices in 1 year, say initial stock price of 40. So we're talking about the initial price of 40, the discount, 5% discount rate, create a risk-free portfolio replicating the put option with 75% unit of the underlying asset, and solve for the put option price. So we're given the scenario. This time the difference is that it's a put option, and secondly, the hedge ratio is different. So note those two things. It's a put option and the hedge ratio is different. It's important to remember put and call option, because the type of option determines where the payoff is. For a put option, the payoff is when the price appreciates. For a call option, the payoff is when the price depreciates. Do you get it? So let's look at it. 1 period binomial model. Again, we are starting with 40. We are assuming that the current price is 40. The price can either move to 56 or the price can drop to 32. Binomial. It's called binomial. And if you've done that in the economics, or I think you're doing it, bi means 2 options. That's why it's called binomial. Correct? 2 options. So it could either go up or down. If it goes up, it will go up to 56. If it goes down, it goes to 32. Remember what I said. This is a put option. If it goes up to 56, then it means that the value of the option would have to be 0. Because the value of the option is max 0, 40 minus 56. And 40 minus 56 will be minus 16 or minus 26, minus 16, right? Which means 0 is greater because the other one is negative, right? But if the price falls to 32, it will be max 0, 40 minus 32, which will be 8 plus 8, all right? So in the first option, price increase, the 40% increase results in the put option value of 0. So we say it's 0 because the price went up. If the price decreased by 32, right, to 32, then the price of the option would then be 18. Sorry, it's not, it's x minus. X is your x minus, not the current price. So this is 18 if the price goes down. So you then come to the second tree, where you have a situation where if the price goes up, the payoff is 0. If the price comes down, the payoff is 18. Right? Now you then go to the third option, where you set up the value at each period. For VO, 0.75 of SO, remember that your hedge ratio is 0.75. So to be 0.75 multiplied by your SO plus your PO, that is the price of the option, the price of your put option, right? Now, in this case, 0.75 of S1 plus P1 and 0.75 of S2 plus P2, where VU1 and VU2 is the same. What we're saying is the payoff, either it goes up or it comes down, should be the same. The payoff, that is V1U or V1U, must be the same. That is the no arbitrage situation. Okay? Now, so if price increases, the portfolio value will be 42. That is 0.75 multiplied by the new price plus your payoff. Your payoff is 0 if the price increases, and that is 42. If the price decreases, 0.75 of 32 plus 18, because that's the payoff, that will still give you 42, right? So clearly, you can then solve, because you then found a situation where V1 is equal to V1U is equal to V1D. But you then equate VO 0.75 SO plus PO equals to, right? Since you then have V1 and V2 equal to discount 42 at 5% rate, and that is PO, which means discount 42 at, I'm talking of this area now, discount 42 at 1.05 must be equal to your VO, that is 0.75 SO plus your PO, right? So you then make PO the subject of formula, which means you solve for this by making PO the subject of formula, and by doing so, you're going to get you're going to get so the final answer is not the final answer is not stated, but you solve for PO to be equal to CN10. So it's given here. So this is the final answer. So the higher put price is as a result of the greater payoff of the put option versus the call option under given parameters of the binomial model. So the factor affecting option prices will be addressed in later detail. So the point here, the whole point here, guys, is that you can use the time value additivity to even find the value of an option, either a call option or a put option, by following this strategy. So we have about 22 minutes left. And so what I would like us to do is, let's try our hands on questions. So let's solve each of these questions. Everyone, it's time to solve. Please, this is the time everyone must solve. This is how you check if you've mastered the concept. So question 1, everyone, please solve question 1. Please solve question 1 and give your answer. We'll also try to time this. So I'm going to give 2 minutes 30 seconds for this. Everyone, please make sure you walk. So let's look at the question together. How would you approach this question? And you are the one solving it, not me. You tell me what to do. Everyone, let's focus. You can tell me what you've done so far, if you've not, and you can solve it together. Okay. First and foremost, how would you approach this question? Semi-annual. What else? Divide the 4 by 2. So semi-annual would be, annualized is 11.6. So that's 11.6 divided by 2, right? The coupon will be what? 10.7 divided by 2. Okay, what else? Huh? You what? Number of period. Okay, period. So what's the number of period? Have a 10 minus 2. Have a 8. That will be. Okay. What else? So, if we're ready to set up. So, how do we set up? Tell me, how do we set up? So, everyone, let's participate together. This is the learning. The learning normal. Yeah? Let's participate. That's how it's done. And no problem. So, what would you have done next?
I want to use the formula.
So, what formula? Oh, you can use calculator. Oh, yes, that's cool. So, yes, you can use your calculator. What the different answer? What answer did you get? 35. 95.52. And there's not a 5.52 then. Set up. Because it's close to 2 numbers. So you can't go see it. So what did you do differently? What did you do? Perhaps we should do width calculation. Let me does that. We're looking at 16. We're looking at 16 period. A lot. Oh, sorry. How are you? You did this one. All right. So, what do we do? The coupon. So, what I would like us to do is, so that it will be fast, take each share coupon and discount it, and just give me the discount value. So, we know that the coupon is 10.7, and semi-annual will be 5.35. Right? Discount this, and give me the plan. In your answer, did you use this? Yes. Did you use this divide by 2? It's a manual. Just wondering why you calculated it right now. Okay, so let's
Discounted figure.
the discounted figure. In those days, when we used to use tools for that calculator, and get the discount rate back. So now,
0.9492.
9492. What's this exactly? Discount rate.
Well, what are you requesting post?
Okay. Alright. Yeah.
Second, 0.97.
0.90. 10. Okay. Yes.
0.855.
0.855.
0.811.
8.18. Yes.
0.7706.
7706.
0.7315.
0.6943.
0.6591.
91. Yes.
0.6256.
6256. Yes.
0.5938.
38. Yes.
0.5637.
5.
637.
5637. Yeah.
0.5357.
5357. 0. Yeah.
0.5079.
Yes.
0.4821.
Yes.
0.4576.
45.
0.43.
4.
43. 44.
Alright. So please, let's multiply. Also do some multiplication and tell us. Tayo, start your multiplication from number 6 to 10. Do the multiplication.
Can you say that again?
Multiply. Can you see the board?
Yeah, that's question 1 and 2.
But you can't see what I've written on the board.
Oh, no, I can't see the.
Oh, you can't see.
Sorry.
All right, just follow the. Well, you see the long. Did you calculate question 1?
Yeah, I was calculating it before you said we should go down.
Oh, okay. So we're going to calculate it here as well. But we're using the long route. So let's see.
Okay.
Yeah.
Take that.
All right. So. So let's calculate. So can you calculate from, let's divide it into 1 to 8. You start from 1, start from 8. Just calculate with 0. Then you change by 5.38. 5.8 is just 5.35.
That's what I'm telling you, it's not figure.
No, that's not. That's the proof one. What you use as the difficulty figure should be 11.6.
It's supposed to be level 5.8.
What's 5.8? This
That's
counting.
right here.
Is that what you use the ranges?
It's actually,
No. It's not even fun. So this is so.
let me think that. So it's supposed to be 5.8.
Yes, we don't have. And do you want to check in your calculator? Did you flip it? Is it possible that you use white TN for coupon instead of coupon for active? Is that why your answer is not possible?
No, the calculator is in the math.
And so I really don't see what. Let's go. Yeah.
0.9452.
Yes.
0.89. 0.844. 0.7989. 0.7543. 0.7137. 0.6739. 0.6377. 0.6020. 0.5697. 0.5378.
Yes.
0.5084.
Yeah.
0.4805.
4875.
4805. 4805.
Okay.
0.4542. 0.4293. 0.4057.
All right. Let's divide 1 to 8 and 9 to 12. Calculate from 9 to 12. Calculate from 1 to 8. Just multiply by this.
Let's do this. Times 5.35.
5.
So the answer is 5,000. That's 0.945 times 5.35.
Yeah.
It's equal to 5.0568.
All right. Yeah. Second. Are you copying it first on the paper? You're copying it first on the paper. Why not just type the review and do it?
The second one,
Yeah.
4.77.
4.77. Yeah.
969.
96. Okay. Third one.
4.51.
4.51.
75.
7.54. Yes.
4.26,
4.26.
98, 35.
Yeah.
Four point zero three
4.03.
55
55.
05.
I think what came on?
3.81
3 point.
0.81
Yeah.
455.
55. Okay. Thank you. What? 3.22. There we go.
Yes, sir.
Okay.
3.0. 2.7.
2.7. 5206.
Yeah. 2.49. 2.29.
2.297.
Yeah. What was the last one? Maybe you said
57.
2.17.
117. Because it's number 60.
6.
I speak of Portuguese. What was there?
4.7.
Then that's 3.6 0 5.6 65.
All right. Let's add differently. Add and add. So that there's an error. Let's add everything together. Something we are missing. That would be the final value. The final value multiplied by this. Right? So the final value will be
So
100.
that was 4.9 second one.
This one, 4 point.
47.
Huh?
4.77.
Yeah. Okay, let's add up. Let's just add up. Let's add up. What's the answer? It's 4.69. So let's do number. Start on joining at this. Multiply it by
54.74.
54.7.
Because I use the first, I don't do the
Okay, you use 2 decimal places.
I didn't do decimal place. I just did the first after that.
As you just did this.
Yeah.
But if you round up if the other one is higher, you didn't round up. And so this number is not like it. And it's not too far from each other. Okay, so let's do discount 100.
So that was in the
Yes.
that's 40.
40.59. So let's take this last one. Let's take this last one. So this would be what?
That's 95.33.
This would be what?
95.33.
What would this be? Sorry. 33. 95. Right? 133. Alright. So what do we have? 595.39, which is closer than. So this is likely the last one is likely the answer. Alright, so our time is low, and we don't want to overrun. So here's what I want us to do. I think we've been able to cover a bit today. The practice question to this problem, I would like us to solve it and post it.